My title is Letting the Air Out of the Balloon. And I chose the word balloon. I did not use the word bubble. Balloon is a nice, softer word. This is not, we're not talking about bubble. I want to start with two comments. One is from Chris Eilman, the Chief Investment Officer of CalSTRS, second the biggest pension fund in the United States after CalPERS here. It says, U.S. properties are priced to perfection. Okay. Next comment is from the Equity Residential first quarter earnings release, and Equity Residential is the largest owner of apartments in the United States, is a publicly traded REIT. And he said operating trends will likely cause same-store revenue growth to fall modestly short of our original guidance midpoint. That's Wall Street talk saying rent growth is slower. Last week, a month later, they cut their guidance again. So something awful must have happened in May because they reported at the end of April, and then last week they cut their guidance again. And largely because there's softness in the New York City area where they have a lot of apartments and in the San Francisco area where they have a lot of apartments. And heretofore, those two markets were viewed as bulletproof by most real estate investors. They were viewed as the two best apartment markets in the country. So that's two telling comments. My main theme is what's going on is operating fundamentals are gradually weakening as supply is increasing for most product types and demand growth is moderating. We're still getting growth, but demand growth is moderating. Technological disruption is having a very real negative effect on retail and office properties, positive impact for industrial properties. And third is the capital market conditions will become less favorable. We're going to go from very extraordinarily easy conditions to just plain easy conditions, but it's not going to be extraordinarily easy. So the capital market will not be as friendly as it has been. All right, this is the Green Street Index of real commercial property. Note it is well above, it's over 20% above where the peak was in 2007 and more than doubled since the lows. And there's one later tick that just came out the other day, and that's up a touch. So instead of flattening out, if I had the latest plot point on the graph, which came out on Friday, it would be up a little bit, but as we're beginning to see a flattening out in real estate prices. Next, the other thing going on is that the CMBS market is in retreat. We had a real boom in the mid-2000s. We were up to over $200 billion a year of issuance. The market disappeared in 2008 and 2009. We got back up to $100 billion. This year, we're going to be down around $50 billion, plus or minus $50 billion, a major source of finance for real estate. And the panel will spend a lot of time on this issue. And one of the real issues is under Dodd-Frank, tick, 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 there's risk retention rules, which the panel will talk about at length, which makes it harder for Wall Street investment banks to underwrite these securities because they got to eat their own cooking, so to speak, which was viewed as one of the problems in the mid-2000s where the investment banks did not eat their own cooking and laid off everything, and we had a whole host of problems as a result of that. CMBS spreads widened out considerably. This is January 2015 to March 2016. It actually goes into April. And spreads widened out considerably, making it hard to issue. They've since pulled back, but they're still relatively wide compared to where they were in early 2015, also making it hard for issuance. One of the other things going on speaks to what Ed talked about. Employment growth is going to slow in 2017 and 2018. And this is this is quarterly job change, but I'll put it in the monthly numbers so people understand a little bit better. We've been used to forgetting about the last month, which we think was a one-off kind of number, is we've been used to getting 200,000 jobs a month, like clockwork for the past several years. That drives retail demand, apartment demand, and office demand. We're going to be down by the end of 2017 to about 150,000 a month. And in 2018, it could be below 100,000 a month. And that's a product of reaching full employment in the economy and very, very slow labor force growth, which is what Ed discussed. So the kind of job growth that the industry has been used to, if you see these things all over, roughly 600,000 a quarter for several years, those days Still true for this year, but those days will be ending in 2017 and 2018, and job growth will be much slower than what we've been used to, and therefore the underlying demand conditions won't be as good. Next this is supply, and this is Department of Commerce numbers where it goes into the GDP. This is real commercial construction spending. We have a recovery. Right now we're running just below $120 billion annual rate. It's going to go up a little higher. Nowhere near the peak in 2007 of $160 billion. Nowhere near the peak of $200 billion, close to $200 billion in 2000. So it's not like a lot of supply, but it's much more than what we've had. So the supply is increasing, and this does not include apartments. There's a separate chart on apartments. So supply is increasing. This is office buildings, and largely office buildings and shopping centers. Includes rehabilitation, which is a lot of going on here. All right. The other thing is we have the interest rate environment will become less friendly. We have the Fed going in July and maybe one more time at the end of the year, and we have long rates backing up. Now, right now, as Ed talked about, is international rates are very low. In Germany, the German 10-year bond is 4 basis points right now. For 10 years to lend money in Germany is 4 basis. The 5-year is negative in Germany right now. Part of what's going on right now in the market, why we have these very low rates, is there's a big safety trade going on because in Europe they're worrying about the British exiting the European Union, the so-called Brexit event. If you will have a big flight to quality if they vote to leave. If they don't vote to leave, you'll probably see a headline: German interest rates quintuple overnight. They will go from 4 basis points to 20 basis points. So something on that order. So part of what's going on is a big giant safety trade going on in Europe, which is affecting our treasuries, is affecting German bonds, and what have you, just in case the British vote to leave the European Union, and that's in 2 weeks. So that will resolve itself pretty quickly. All right. The real drama right now is in the mall real estate. E-commerce is here to stay and is taking bigger and bigger share, and I'll show you some numbers. The department store business is very bad. Macy's and Nordstrom's reported horrible results in the first quarter. Both of their stocks are raw 50% from their 12-month highs, and the overall stock market is within 1% of the all-time high right now. So you have real issues in the whole department store industry, and according to several studies, 600 to 1,000 department stores are going to close over the next 3 to 7 years around the country. What that means is the B and C malls are most at risk, and my line is that's where retailers go to die. It's the it's the elephant burial ground for retailers of the B and C malls. The A-plus malls are safe for now, and Peter Lowy is going to talk about his assets, and I'm sure he will say that what he's been doing, he's been selling his B and C malls and reinvesting in his A-plus malls, which you see going on in Century City Shopping Center right now. Now, this is e-commerce as a share of retail spending. It started out as, here we go, I don't know. It started out at less than 1% in 2000. It's now about 8% of all retail spending. And notice the acceleration in 2015. Okay, but the thing is, if you look at the relevant market share, it's a much bigger share of the overall market. Share of total retail sales is about 8%. But you can't buy everything on the internet. You can't buy an automobile on the internet. It's very hard to buy gasoline on the internet. It's very hard to go to a restaurant, part of retail sales, on the internet. And normally, in contestable markets, very few people buy their groceries on the internet. So if you back out those groups, and I left in building materials and a lot of buildings, so I'm being conservative here, building materials, some you can and some you can't. You're not going to buy wallboard, for example, on the internet, or rebar on the internet from Home Depot. All right, so X those groups, e-commerce is now 14% of the relevant market, not 8% of what the internet can contest. Then you do one more thing. You take a look at the share of the growth, the incremental increase in sales that the internet accounts for in this group, the total retail ex autos, gasoline, grocery, and restaurant. It accounted for 30% of the growth in the last 16 years. Internet, e-commerce, eating, store-based retailing, eating their lunch. And if you look at the last 5 years, it's 44%. So you sort of think, what's going on? Hello Macy's, hello Nordstrom's, hello Limited, and yesterday, hello Ralph Lauren, which is closing 50 stores. And Ralph Lauren is sort of the high-end, supposedly bulletproof. They're closing 50 stores around the country. So this is the fundamental problem structurally facing store-based retail is that it looks like you don't want to be in the way of Amazon. And I will just tell you a little vignette. I live in New Mexico. We had a very fancy wedding here in Los Angeles last month. Where does my wife buy her shoes? You know, it was a big deal for the wedding. On Amazon, Zappos, Amazon. So, and you don't think you'd go to a store? No, she bought it from Amazon. And then we were traveling, and we went into Nordstrom, and the Amazon selection, what she chose at Amazon was better than what was available in all the millions of shoes, at least to my eyes, millions of shoes at Nordstrom, and she stuck with the shoes that she bought from Amazon. And this is a big deal, you know, for the kind of wedding we went to. Shoes were, not for me, but for her, very important. All right. Now, this is mall vacancy rates gradually declining, but they're still, like the employment charts is, they're nowhere near the lows of 2006. This is strips, and regional malls are in red, and strips are in blue. But this data doesn't include everything that's been shuttered that's not being offered for lease. So the real vacancy, in a sense, is a lot higher than this because it excludes everything that's been shuttered because they're not in the broker databases because they're not being offered for lease. So there's real structural issues facing the retail business. Now, the beneficiary of all this is close-in industrial space because you have to take care of the last mile and you have to serve the ultimate consumer. So rents are up 5% year over year in the industrial. They're up double digits in Oakland, northern New Jersey, and LA. And Dick Simon, you could tell me, is that true or not? True, okay, because Dick has a company that has a bunch of industrial, close-in industrial. And stocks, and it's good for you, Dick, okay. And the availability rate has dipped to 9%, and that's the vacancy rate. That's how they call vacancies in industrial space. It's 9%. It's down from 14.5% in 2010. And this looks like it will continue as the e-commerce people get closer and closer to the consumer. They'll need warehouses closer and closer in, and they probably will pay extraordinarily high rents to get close to the consumer. So that's continues to be the beneficiary of e-commerce. They're on the right side of the trade right now. Now, office vacancies, gradually, very, very, very slowly coming down. This is national office vacancy rate. Got up at 16%, it's now in the 17%, it's now in the 15%. It's not coming down fast. It's not like other cycles, it's just hanging high. Now, why are office vacancies nationally? Now, obviously, there's some hot markets where they've come down faster, but on the whole, on the average, they haven't come down all that much. More of the weakness is in suburban than in center city, but it's still taking a long time for vacancies to come down. The first thing is that traditional drivers are not what they were. Financial activities, which is finance, insurance, and real estate, that employment hasn't gone back to the 2007 peak. And in fact, we think it's going to drop because we hear all kinds of signs that banks are going to lay off people, both Wall Street type banks and regular commercial banks. And a lot of the big growth in that sector has to do in the health insurance sector, when all the health insurance companies had to hire call center workers, which is in this number, to handle with the individual clients associated with Obamacare. So that growth is now behind them. They've staffed up for that, and that's part of that increase in the growth, and that growth is largely behind us. The other thing is the law business is not what it was either. And there hasn't been any real growth in legal services employment. Now, there's some lawyers employed by business firms, but that doesn't count in legal services employment. This is just a traditional law firm. And legal services employment has been flat for the past several years, and it has not really recovered since from the 2008 and 2009 recession. So therefore, you don't have the demand that you used to have for office buildings. The other thing here is tech, and this chart is not a level chart. This is a rate of change. This is the change in jobs This is the change in employment in thousands, and this is computer software, basically, this chart. And we were up to 120,000 a year, big gains in computer software employment, and that's what's driving Silicon Beach over here, San Francisco, San Jose, Seattle. You go around all the markets in the country that are hot office markets, they're there because of tech. And the markets that don't have tech aren't working as well. And you look within submarkets, is like Silicon Beach is much better than Brentwood here. In New York, Park Avenue South is much better than traditional Park Avenue in Manhattan. And so on. So that's beginning to decelerate, and that's one of the issues in the San Francisco, San Jose market. What Jerry talked about, the potential slowdown, is they begin to see the slowdown in employment growth. It's still growing, but it's not growing as fast as people were projecting, and that's where pro formas might go awry. Now, the other thing happening is this technological disruption on the office side, because the square footage per employee, which used to be, space planners used to use 200, 225 square feet per worker, is going down to 150 square feet per worker, because you don't need reference rooms and filing, because all that stuff is going to the cloud. And I was just speaking to someone who was involved in a major space plan and a major lease in downtown investment management firm, and they're basically rearranging everything, and they're saying there'll be no file, everything will be electronic, no filing, no what have you, no traditional offices for people, a lot of open floor plans, and they're gonna put more groups on the same floor that they used to have in their new lease and in their move, because it's just much more efficient to run with an open floor plan than the more traditional plan. That means more people on each floor, and that means less demand for space. And the other thing is all the technology tenants use it very intensively, and they're down to 130, 140 square feet per worker. Can't get really much below 120 feet in a high-rise building because you got fire code. You got fire code issues. So 120 feet is probably the limit on space per employee on a high-rise, in a high-rise building. So this also could make older buildings obsolete because they're not suited for this dense pack kind of environment. Now, apartments have been the poster child of what's been great with real estate. We've had construction going from 80,000 units up to about 400,000 units off the lows. We think we're going to have around 400,000 starts. Now, our number includes 2 to 4. Most industry people use 5+. So whatever, if you're using the traditional definition of multifamily that other people use, take 20,000 units off all of these numbers. We start at 2+, and most people use 5+ for multifamily. But multifamily remains very strong in terms of start. Rents are rising close to 4% a year. That's on the government data. The real data was 4 to 5%. Some markets 7 or 8%. And part of it is rent control in these markets basically suppresses the government data. And it works with a lag because you're asking in-place rents rather than market rents. So the real world numbers are higher than these. So when rents actually begin to roll over, the government data will be higher than what the market is. And the other thing is vacancy rates have bottomed, and this is one area of the market where vacancies have actually come down the way they're supposed to in a good economic recovery. They've went from 8% down to 4%, but we're beginning to see the impact of new construction on the vacancy rate, and vacancy rates are beginning to rise. And the other thing that's going on is the market has been building for the very, very high end. And I think most developers don't realize it, but there's a very limited market for apartments that rent for $3,500, one-bedroom apartments that rent for $3,500 plus a month, and that's the market they're building for in New York, San Francisco, parts of Los Angeles, and what have you. And that market is pretty thin, and they're beginning to find out that, and that's going to lead to a slowdown later. And the other issue is, on the apartment side, is when will the home ownership rate bottom? We think it's looking for a bottom right here, and part of what's driven apartment demand has been the big collapse in home ownership, and that might change. And our sense is life cycle, a lot of life cycle events because of the Great Recession have been postponed in terms of marriage and children, and we think that we may begin to see a bottoming of the home ownership rate somewhere around the level we're here. So that source of demand will go away within the next year or two. So let me conclude. It looks like to us is that the very long bull market in commercial real estate is ending, or we're flattening out. Maybe it's a long sideways correction. I like to use the term flat to down where prices stay up where they are. In some cases, they go down a little bit. You know, if you look at the overall stock market, the S&P 500 hit 2,100 in December 2014. We spent most of the time below 2,100 in the past few years. Today, it's just a touch above 2,100, and we've had a flat stock market for 18 months. Real estate is now linked to the capital markets. So you could sort of look like for real estate, commercial real estate prices on the whole, on the average, we're in a flat to down kind of environment. Because supply and demand fundamentals are weakening, and the capital markets are turning from being extraordinarily friendly to just plain friendly, but not as good. And the technological disruption is a big deal, and if you're not focused on that, you're going to have a real problem. Thank you very much.